Hey everyone, it's Julie here with TipRanks, and today we're taking a look at two tech stocks with recent analyst upgrades. So let's get into it. Alright guys, welcome back. Thank you all so much for being here, and TGI Friday. Today we're taking a look at two stocks in the technology sector that have had Wall Street analysts recently upgrade their ratings on the stock. So we're going to take a look at these companies, what it is that they do, and what those analysts are predicting for the stock's future. Just before we get into today's stocks, this is a friendly reminder that if you enjoyed today's video, make sure you hit that thumbs up button and that you're subscribed to the channel. You can follow along over on the TipRanks website or with the TipRanks mobile app. Links are in the description down below. Now let's jump right into our two tech stocks. First up today, we're taking a look at a company called Couchbase. They trade under the ticker BASE, currently priced at $16.24. In the past year, the stock is up 7.9%, but has been in the red lately. In the last 3 months, it's fallen 18%. Couchbase is a modern database platform provider that offers users and developers everything they need to support a wide range of applications. From cloud to edge to artificial intelligence, Couchbase bills itself as a one-stop shop for data developers and architects, making its services available through its powerful database-as-a-service platform, Capella. Organizations using the service can quickly create applications and services that deliver premium customer experiences, giving top-end performance at affordable prices. They can support database services for a wide range of AI applications, including the latest Gen AI tech, as well as database search, mobile access, and analytic functions. Their customer base includes major names like Verizon, Walmart, Cisco, Comcast, and PayPal. They shared their Q2 earnings report at the start of September, where the company did report a narrower than expected loss and saw some double-digit growth for revenue year over year. For their second quarter, they reported a loss per share of 6 cents, which was 3 cents narrower than analysts had been anticipating. Revenue came in at $51.6 million, which was an increase of 20% year over year and also beat expectations by nearly $500,000. Annual recurring revenue increased 18% year over year, and their gross margin for the quarter was 87.5%. Looking forward to the year ahead, they're anticipating total revenue of $205 to $209 million, which was in line with expectations of about $207. Couchbase has recently had two Wall Street analysts upgrade their ratings on the stock, one of them being Daniel Ives from Wedbush. He noted that the company has pivoted its business towards Capella both from a product and go-to-market perspective, with most of the product investments now being focused towards the cloud offering. The firm clues Capella as a game-changer for Couchbase with easy adoption or deployment compared to alternative customer-managed offerings. They believe Couchbase will see strength across net new logos, while the launch of its new products will re-accelerate its growth over the coming quarters. And we also saw an analyst from Barclays upgrade their rating as well. They think the current share price level represents an interesting entry point. The company's new cloud product, Capella, is making it easier for customers to adopt the solution, and there's evidence for this in increasing customer growth numbers. The firm says that while two customer losses pushed shares down after their third quarter results, they see a comeback already in Q4 when the first customer expansions come through. Couchbase does come in as a moderate buy overall, as we do have one sell rating. With 13 analyst ratings, we have that one sell, 10 buys, and 2 holds. The average price target comes in at $22.62, representing an upside potential of over 39%. Looking at those ratings down below, we can see both Barclays and Wedbush here with their upgraded buy ratings, and slightly different price targets here. Barclays has an upside of 17%, while Wedbush is feeling a bit more bullish with an upside of 60%. They aren't the highest price target though. That goes to Robert Baird here at $27 for an upside of 66%, while our low-end price target is that one sell rating from back in September with an upside of 4.7%. And our second tech stock with some upgraded analyst ratings is Dynatrace. They trade under the ticker DT, currently priced at $54.22. Overall in the past year, they are up about 23%, though year to date they were in the red slightly. They've been climbing back recently, gaining 22% in the last 3 months. They do currently score a 10 out of 10 on the TipRanks Smart Score, with some notably increased hedge fund activity. Dynatrace offers its customers AI-powered cloud-based data management technology. The company's platform supports intelligent automation that puts network management, cloud monitoring, and data analytics to work in one place for a unified mission. Their platform can be applied to almost any aspect of the tech and business worlds, allowing its users to tap into AI-powered app automation, business analytics, digital security, infrastructure monitoring, and microservices. They have more than 4,000 subscription customers, generating approximately $1.5 billion in annual recurring revenue. And they also count some big names among their customers, including Dell Technologies, Air Canada, and the Government of Australia. They shared their Q1 earnings report at the end of August, where they came out with an earnings and revenue beat and exceeded the high end of their guidance across all metrics. Their Q2 earnings report will be coming out in a couple of weeks on November 7th. For their Q1, they reported earnings per share of 33 cents, beating expectations by 4 cents per share, while revenue came in at $399 million, which was an increase of 20% and beat expectations by over $6.5 million. Their annual recurring revenue increased 19%, while subscription revenue increased 21%. Once again, Wedbush analyst Dan Ives is one that upgraded their rating on the stock. He cited incrementally better field checks and the artificial intelligence revolution picking up that will provide a stable tailwind for Dynatrace going forward. They are the leader in observability with an expanding portfolio and have a long runway for growth. They believe the company has a unique combination of growth and profitability with the highest margins in the space. And once again, Barclays is the other firm that recently upgraded their rating. They said that over the past few years, there have been a number of moving pieces investors have had to juggle in the Dynatrace story, between Thoma Bravo selling down its stake, the company launching its next-gen products, and most recently them adjusting their sales organization to better sell the larger solution set. With these changes now behind the company, combined with the much easier competitive setup, Dynatrace is on a path to offering solid growth from here, paired with continuing ongoing margin expansion. With 20 current analyst ratings, Dynatrace does come in as a strong buy with 18 buy ratings and 2 holds. And the average price target comes in at $60 per share for an upside of nearly 11%. Looking down below, we can see a lot of analysts increasing their price targets, including Barclays and Wedbush. Wedbush going to $67 for an upside of 23.5%, which is our high-end price target, while Barclays at $64 being an upside of 18%. Our low-end price target is back in August with our hold rating and a downside of 17%. So that is a quick look at 2 tech stocks that have both recently been upgraded by analysts. Let me know your thoughts on these 2 companies in the comments down below. I always love hearing from you guys. Keep in mind these videos are never a suggestion to buy or sell any specific stock, just sharing what Wall Street is up to, so please make sure you always stick to your own investment plan. Thank you guys so much for watching. Have a great day, and I'll see you back here next time.